Hey everyone, it's Daniel from InfoVest. I just want to quickly go over some article that I found here on Wall Street Journal. Its title is Federal Reserve's Portfolio Runoff Has Begun. So for those who don't know already, that the Federal Reserve has already started its balance sheet runoff, started to sell a lot of bonds in the market, treasuries, sorry, not sell, let me correct myself, started the balance sheet runoff in terms of maturing their bonds when it comes to treasuries and mortgage-backed securities. So I wanted to share a couple of things here. Let me just share my screen. Okay. Okay, so a pretty interesting snippet here. There was a question in that article that mentioned, and I'll link it in the description. There's a question here that says, what about mortgage securities? Some of the Fed officials have said those could be actively sold at some point. And why is this under consideration? So the answers that were posted here, and I highlighted it here, the Fed has said that over the long run, it wants to own primarily Treasury securities. Okay, selling mortgage assets would more quickly shift the composition of its asset holdings toward treasuries. So pretty interesting comment there. And again, the Fed didn't actively sell mortgage bonds last decade, but it never ruled out such sales. And it hasn't ruled out sales of its 2.7 trillion in mortgage-backed securities at some point down the road this decade, because it will take a long time to shrink those holdings passively. So pretty interesting comment there that, the mortgage-backed securities that is on the Fed's balance sheet, right? Right now, what they're doing is they're letting those bonds kind of mature, and they're not reinvesting that into purchasing more bonds. But the question has come up now that some Fed officials mentioned that possibility of completely removing the mortgage-backed securities from its balance sheet and just solely rely on Treasury securities. So that's pretty big because this influences also the housing market when these MBS or these mortgage-backed securities are bought and sold. My lights went off, so please ignore that. But we'll keep this unedited, so we'll continue with the show. So let's continue here. Mentions that some officials haven't decided whether or when to sell securities, and minutes from the Fed recent policy meetings haven't provided many clues about debate inside the central bank's rate setting committee. So still there's chatter about this, but there's not really a definite answer whether they're going to go with the balance sheet selling of the mortgage-backed securities. And the reason is because we see another comment here, because mortgage rates have increased substantially, officials will have to weigh the economic effects of any such sales at current interest rates, and the Fed is also likely to sell those assets at a loss if they do so, right? So when you look at the rates, right, and you look at the benchmark of the US 30-year Treasury yield, right, look at this huge selling or lowering of the 30-year yield since back in the 1987 until now, or the low of March 2020, where we went from levels of almost 9-10% all the way down to less than 1%. And now we're seeing the 30-year yields basically break this massive long-term trend line, and we're approaching back to May highs again, which is around 3.33%. So right now hovering around 3.19%. And the 30-year yield generally influences the mortgage rates, right? So if we get a continuation of these yields pushing up higher and higher, maybe back to even 2018 levels, or around 3.4, 3.5%, right? Will the Fed consider selling those mortgage-backed securities? And if they do, what will happen to those yields? Definitely you could see those yields, and definitely you could see mortgage rates continue, especially the mortgage rates talking in particular the mortgage rates, definitely you could see mortgage rates continue to rise because you've got a big behemoth central bank coming out selling those mortgage-backed securities, which are influencing the higher rates in those mortgage rates, and that putting downward pressure on real estate prices in the market. So definitely that would be very, very negative if we went and if the Fed decided to consider that and start that soon. But we don't know for sure. There's just rumors talking about it right now. So it's something to consider, something to look out for. Now, again, this is not financial advice. This is just me giving education about what's happening in the markets and explaining about these developments. So I'm not calling anything about a real estate crash, or I'm not calling, not giving any financial advice. So please, I'm not a financial advisor. But I do want to share a couple of more information here. So other than this Wall Street Journal article, I found a couple of clips of comments from certain Fed members, right? Because when you look back here, the question was, some Fed officials have said those could be actively selling those mortgage-backed securities at some point, right? So who are those Fed officials? So here are some of the comments if we backtrack a little bit. Okay, so here it is, John Williams, right? Vice Chair of New York. He's a neutral when it comes to his stance on monetary policy. So in all of this huge paragraph, basically mentioned here, reiterated mortgage-backed security sales might be an option in the future, but it's not currently under consideration. So he did recognize that that could be an option, especially if demand continues to overheat, if prices continue to overheat, because right now you're seeing a big issue with inflation, right? Big issue. You're seeing high inflation levels that you haven't seen in 1980s. And the question is, how is the Fed going to cope with the slowdown in the economy and with higher inflation? How do you bring it down, right? Because you can't print, you can't, what can the Fed do right now? They can print money, they can raise rates, lower rates, sell bonds, kind of run their balance sheet runoff. They've got a couple of monetary policy tools that they can do financially, but they can't go out and start producing oil to bring oil prices down. They can't go out and start printing lumber or whatever, right? You can't to bring down, even though lumber prices have come down, but you can't go out and start producing a lot of commodities to bring down the prices on from a lot of these commodity prices that have been rising. And you can't go to China all of a sudden and start opening up borders and fixing these supply constraints, because part of this massive inflation that we have seen came from also the huge supply constraints issue that we're seeing globally. And plus the Ukraine-Russian war with higher prices, food prices, et cetera, et cetera. So the Fed has no control on that. What they can do is kind of influence the demand side. And how do you influence the demand side? By adjusting the rates and adjusting the money printing. So if you've got inflation around the 8% mark, how do you bring it down? You've got to lower demand. You've got to be aggressive with those rate hikes and also on your balance sheet runoff. Now, they say that the Fed officials are not right now considering selling mortgage-backed securities. However, they talked about in the future, they don't want that on the balance sheet. They want to just deal with treasuries. So that's a pretty big note. Could they utilize the inflation as an excuse to really bring down demand, push down prices lower, push down housing prices lower, and really affect the markets to bring that inflation lower? Could they use that excuse? It's a possibility, right? Let's take a look at other Fed members here. So James Bullard, right? Another hawk, a voter. So he said that on the balance sheet, he said it is not exactly clear what the effect of shrinking the balance sheet will be in the US or globally. And he reiterated that MBS sales are a possibility, for the Fed, but that would be far in the future, right? So again, far in the future. It's a possibility, but far in the future. And this is what the Fed members do. They start giving you nuggets, clues and nuggets of information of what to expect in the future. So it's not a big shock to you, right? I'll give you an example. The Fed, right? We haven't even reached neutral zone. And if you look at the stock market itself from January till now, it's been, NASDAQ especially, has been down 30%. So through communication, it has already conducted tightening within the markets through communicating certain information to you and to the public and to everyone else and all the investors and traders that caused the selling, right? So if they want a continuation of more tightening in the markets, they will start communicating it to you that, right now they're saying it's a possibility, but maybe down in the future. What does future look like? When is that, right? Maybe that is after September, maybe that is in December time, or maybe next year. I don't know. We have to watch, and we have to see how especially inflation data comes out in the next couple of months, because that will also give us more of a clear answer of how the Fed might react, right? So if that starts coming into the discussion that, okay, maybe we got to start selling these mortgage-backed securities, and if they start getting more aggressive with it, that they're raising rates and even selling. Now that's a big thing, right? You're going from letting the bonds to mature to now actively selling in the market these mortgage-backed securities. That's definitely going to put higher pressure on those mortgage rates, which is going to put downward pressure on the home prices. And we've seen during COVID and post-COVID, a lot of prices and home and real estate values and prices have skyrocketed just because of all the money printing and the supply constraints that we've been seeing. So if they wanted to reverse that and they wanted to use the high inflation as an excuse, and if you take 1980s as Paul Volcker as an example, right? Not saying that they will bring rates to 17%, not saying that, they will be exactly like Paul Volcker, but having him as the icon and the symbol to not get close to his level, but to somewhat be a little tad more aggressive than usual, because you can't get to Paul Volcker's level, especially with the amount of debt that the U.S. has and the amount of money printing that has been done. So that will just mess up the economy completely. But can you make the consumers feel the pinch? And that could come from really affecting the home prices. Now you hear other people like investors and traders like Michael Burry coming out and mentioning that this sell-off or this recession that he sees kind of resembles close to 2008 levels. And every time, when we get into some sort of recession or talks about recessions or crash, people keep relating it to 2008. Right. So we'll have to see, again, I'm not calling that the housing market's going to completely crash, but it is something to keep an eye on, that if they really go down that path, it does look ugly and it doesn't look good. And definitely you can see prices come down drastically. So let's take a look at the other Fed members as well. So we have Mester. Mester's known to be a pretty big hawk as well. So she mentioned basically on the balance sheet, Mester said the Fed needs to consider selling. So this is what Mester said. The Fed needs to consider selling MBS, but warned potential losses on the Fed holdings would raise communications issues over the merits of shrinking the balance sheet. So she's saying that, let's do it. Let's go. We need to really consider comparing. When you compare with the other Fed members, they're more kind of they sound a little bit more dovish when it comes to the selling of the mortgage-backed security. They say it's a possibility, but that's something far in the future. We're not even talking about it right now. But Mester, on the other hand, is like, okay, we need to consider this. This is something we have to really talk about. Now, there will be some issues with the losses on the balance sheet, which could prevent it. And the other thing too, also that, another thing that could prevent from them selling mortgage-backed securities, if we all of a sudden get into a recession, get into a crash that takes us way lower down in the markets, and you'll start hearing people talking about the Fed put again, right? The Fed put, where they will come in and they'll start accommodating the markets and helping the markets by printing money all over again to stimulate and move the markets higher. Now, the question I have is, when you have high inflation and weak growth, or if you get into recession, will there be a Fed put very soon? The question is, how fast will it come? Will it come as fast as like it did during COVID, where we had a V-shaped recovery, or will it come later in the stage and the Fed will purposely cause and create damage so that demand can really push? Because like I said, they don't have control on what's happening with the supply side and what's happening in China and the Ukraine and Russian war. They can't go out and start, producing oil into the market and etc. They can only control the demand side, which to lower kind of prices, because a lot of the supply side is really affecting and elevating these prices, and especially inflation. So will the Fed put come in not as what people are expecting, which could cause an additional shock to the markets and a continuation of a sell-off, right? Which is why, Michael Burry and some of these other notable investors out there are predicting an additional sell-off in the markets, more than a 30% drop that we have seen so far. So we'll have to continue to monitor that and see what happens. Here's another interesting one, where you have home price to median household income ratio higher now than it was back in the housing bubble, back in 2007, 2008. So we basically reached above levels where you see housing prices way above somebody's income, way above, outpacing the growth of somebody's income, their salary, which is making it harder and harder for someone to go out there, purchase a home, or make their payments, right? And every time we have these massive peaks, if you see, we have a peak here, we come off a bit, have a peak here, come off. We had this massive peak in this bubble, which then the ratio came down, and we're seeing the same thing again. Now, will we see that number come off again, especially if the Fed goes very aggressive with this? We'll have to see, right? Here's another interesting chart where you have real home prices versus real disposable income. And this is comparing the US versus Canada, right? So you're seeing in US, we're starting to peak above that home price number, and I'm sure there's another chart now that's more updated than this one. I'm sure probably the numbers up here much higher, but when you compare the home prices versus income, again, it's an issue. You're having the higher prices of homes versus your income level to sustain your mortgage and the mortgage rates and et cetera and et cetera. And every time we peak and we get above this level, again, like we did back here and here and here, we tend to come off again. So again, is this also, inferring that we could see the same thing down the road? Now look at Canada's chart, right? Insane levels. Back long ago, post 2000 and onwards, prices have just been elevating. Everyone, I keep hearing in Canada that, housing prices are going to crash. They set it back here and it continued to go up. It set it also during COVID, but it didn't happen, and we skyrocketed from there as well. Now with Canada and the Bank of Canada coming out and saying that they want to raise rates to not only the 3% area of the neutral zone, but above it. You have the deputy coming out and saying that wanting to go above the neutral zone, above 3%, to really bring down those home prices. So if you've got that tightening on that demand side and you've got inventory coming down, definitely you could probably see prices come down. The only question is how much, right? And how aggressive would it be? And I think that answer will come all down to what the central bank does. What are their plans? Do they really plan to cause, and even though they're not saying it, but cause a very aggressive recession or even a depression in the markets and the economy that can really bring down prices, and using this high inflation as an excuse to do so? And maybe even for the Fed, using this as an excuse to get rid of the mortgage-backed securities. And if the Fed does that, right, there's no mortgage-backed securities anymore on the balance sheet. What does that mean in terms of the future? Does that mean that when it comes to safeguarding the housing prices or safeguarding the housing market and stimulating it, they won't be much of a big player to help out? Well, maybe, maybe not, right? Again, they don't want the central bank's goal is not to collapse the economy completely and collapse people's finances. They're not there to do it. They've got two mandates. One is to make sure employment's doing well and make sure that inflation reaches to that 2% level. Well, obviously, we're not at that 2% level. So this is pretty interesting. Let me know what your thoughts are. Comment below what you think where housing prices may be going. We hear every single time realtors come out and say, don't worry about housing, don't worry about housing. And they've been right so far, right? Especially in Canada, that prices have been rising. But will this be a change for the first time? Will it be something that we will all see and witness, which is very drastic and dramatic for the markets? And will it be 2022 or 2023 where we really experience a massive sell-off? So tell me what you guys think in the comments, and I'll see you guys in the next video. Thanks, good luck, and I'll see you around.